Trident Royalties is a growth-focused, diversified mining royalty and streaming company, and it provides investors with exposure to a mix of battery metals, precious and bulk metals. The acquisition and aggregation of individual royalties and streams is expected to deliver strong returns for shareholders, as assets are acquired on terms which reflect single asset risk compared with the lower risk profile of a diversified larger scale portfolio. The share price is currently 36 pence, around 36 pence. The market cap is around £105 million, and brokers Liberum have a target price of 77p currently. CEO Adam Davidson joins us live from Denver in the United States. Welcome, Adam.
Hi, how are you?
I'm excellent, thank you. It's fantastic to have you joining us on a webinar, kicking our webinar off. Now, what do you want to tell us about tonight, Adam?
Yeah, I'd like to touch on the business model just briefly, and then primarily focus. As you said, we've done 5 transactions this year, and then most recently just announced an updated debt facility, which helps us grow the business. So a lot of recent active news that I think would be worthwhile to touch on.
Fantastic. Over to you then, Adam. We're looking forward to this.
Great. I just flag this is by and large the same presentation that's on our website. So the disclaimer and all these slides will be available for people to view separately. As Donald mentioned in the intro, we're a mining royalty company listed on the AIM market in London, and also have an OTC listing in the US, which we did this year, and it's seeing increased volume as we go. But really the intent is to build out a diversified portfolio of mining royalties from which we derive income. So just very briefly with regards to sort of background on the business model itself, you can see here the benefits of mining royalties relative to investing in mining equities or investing directly in mining physical commodity, whether they're ETFs or other instruments. And really the key thing for us is that if you hold a royalty over a mining property, as it produces and sells material, we get a percentage of the revenue that's derived from that property. So not dissimilar from investing in mining equities, except the big differentiator is we get top line revenue of the P&L. So we're just getting a cut of their revenue. Whereas if you're investing in mining equities, effectively your exposure is at the bottom line of the P&L. So you're getting a cut of profit. And I think what we see in environment like we're in today, gold price, for example, is streamed up to all-time highs recently. It's still north of $2,000 an ounce. So the gold miners should be making good money. However, they also are facing inflation with regards to their costs, paying more for labor, paying more for diesel, those sorts of things. So what you may find is although commodity prices may be strong, the actual profit margin of the mine operators may be the same as they were last year. They may even be tighter than they were last year. Well, royalties avoid that sort of risk in that we get exposure to just their revenue. So if they're year on year producing the same amount of metal and the price goes up and we get 1% of their revenue, then we benefit from that upward price environment. And yet we still get the asset level exposure, which is the reason people invest in mining royalties versus simply just investing in metals ETFs. The metals ETFs aren't linked to specific assets, and in mining, 80+% of assets that commence production either extend their mine life or expand their planned production profile. So it's that sort of asset level exposure that you still get with a royalty, but you're protected from the cost side of the equation. So that's the business model in a nutshell. And then if I just jump ahead to highlight the style of exposure that we're providing, you'll see that I'm skipping through a few slides, so please go to tridentroyalties.com and review this in more detail, but I'd like to leave as much time as possible to talk about our new transactions. So what this slide highlights is the breakdown of our portfolio as we stand today. A couple key things to flag here. We've been listed for just a little short of 3.5 years. When we listed, we had just a single iron ore royalty on an asset in Australia. It's been a great investment for us. But we had just one single royalty, so we weren't exactly offering sort of diversified exposure to the entirety of the sector. But if you fast forward to today, we've now got 21 assets, 13 of which are cash flowing. You can see the analyst consensus estimates of our net asset value by commodity on the right side of this slide. Effectively, 40% of our exposure today is in lithium, spread across a few assets, with about 30% of our exposure in gold and then 20% in copper. The balance is spread across silver, iron ore, and mineral sands. In fact, you can see that initial iron ore royalty is now represents less than 2% of our overall net asset value. So we've been pretty pleased with the progress to date with regards to spreading out the diversification of the portfolio, because that really is the key objective. Now, just jumping ahead to a couple of our transactions for this year. Our most recent was on a copper royalty, which we were really pleased to get. It's hard to get good copper exposure, and what we think we found here is an asset that is, one, located in a very good jurisdiction within the U.S. in Arizona, which is a mining-friendly state, produces most of the U.S.'s copper output. The project itself is located on a brownfield site. That means it was a copper mine previously up until sort of the 1970s. The operator actually owns all the surface land where there would be surface infrastructure, which streamlines the permitting process. And effectively, we put a royalty over top this property. It's at the sweet spot with regards to development timeline, where they intend to publish their pre-feasibility study before the end of the year. And that kind of marks, roughly speaking, the midway point of a mine going from exploration to in production. So, they've done their scoping study. We priced our deal on the scoping study economics, and it stands up very well. It's a good return profile. But they'll publish the pre-feasibility study here shortly. And then from there, you kind of move on to the final feasibility study. And then that really triggers the process to commence fundraising to actually build the mine. So we're sort of sitting between scoping study and feasibility study with the pre-feed sort of imminent. We find that that's a really sweet spot with regards to where we can find value. Obviously, if an asset is in production, what you tend to find is that you have to pay up to secure a cash flowing asset. People don't want to let those go cheaply. And if the asset's too early stage, it's in the exploration stage, then the clarity to when it will be in cash flow is pretty long dated. And we find that our investors, they want something that is right in that sweet spot in the middle, where we've got good clarity of what this can look like. In this particular case with Antler, based on the scoping study, it's a 13-year mine life, producing 33,000 tons of copper equivalent a year. So as it stands today, has the size and scale to be a mine, but then we expect it to grow as they do more drilling and as they publish subsequent studies. And yet we still have that clarity to cash flow. Hard to read, but you can see the Gantt chart in the lower right. This is from the operator's presentation. They flag pre-construction activities commencing in, sorry, I see the slides didn't advance. You can see the Gantt chart in the lower right flags pre-construction commencing in the first quarter of 2025. Now, obviously, when we're doing our analysis, we flex the dates at which we see the asset turning on, but I think we put that in there really just to highlight the fact that the asset is very much focused on moving towards a construction decision. So really pleased to have added this one to the portfolio. So Antler was announced in November. The slide that I'm showing now is on the Paradox Lithium royalty. We acquired this one in September. So we've been exceptionally active here in the back half of the year. In this particular case, the royalty is over all properties operated by Anson Resources in the Paradox Basin, which is a huge area which covers a chunk of Utah and Colorado. And in fact, Anson Resources, a good ASX-listed operator, has 3 projects within the Paradox Basin. But the most advanced is the Paradox project, the lithium project. I flagged the sort of stages of a project when I was speaking earlier. And in this case, the asset's more on the advanced side, so it's done its sort of scoping and pre-feed stage. And in fact, last year they published their feasibility study, and they're working on a final feed study now, which is kind of the last step before you pivot to sort of a construction decision. So this one's, as we see, an advanced stage lithium brines project. It's in fact DLE, so direct lithium extraction. Some of you may have noted that Exxon recently announced a similar project in Arkansas in the Smackover Formation, which would be using similar technology. So this is sort of an earlier stage technology. There is lithium that is produced via DLE. I think about 35,000 tons of lithium were produced last year, but it seems to be growing in the sector. So we were really pleased to get a royalty over an asset in the U.S. that's at advanced stage and utilizes this technology as a way for our shareholders to get exposure. The other thing I'd flag on this particular transaction is in the lower right, you can see the deal structure. It's a $10 million headline deal, but we only put down $1.5 million up front to secure the royalty. The second tranche is due once the asset has hit commercial production. And the third tranche, which is a full 50% of the consideration, isn't payable until 2 years after the second tranche. So it allows us to get a lock-in exposure to an exceptional quality asset. We flag in here at $25,000 per ton lithium. It would be spinning out $8 million a year to us as the royalty holder. That's based on the DFS. It's got a 23-year mine life. The resource has increased twice since they published that DFS. Most recently in October, the month after we bought the royalty, the resource was increased by 40%. So that's a much larger project. We expect the FEED study is going to relay a project size that's in excess of what we saw in the DFS, which is what we predicated our economics on. So again, really pleased to get this one into the portfolio. And I might just skip over the next couple slides and jump down to our balance sheet in the interest of time and to leave a good amount of time for questions. But we have done a number of deals this year. That said, we still have some capacity within the company. You'll see on here that our most recently reported cash balance was $25.6 million US. We've done a slew of deals, and the most recent Antler isn't taken into account in that number, so we spent roughly $7 million US. So still got a good amount of cash within the portfolio at circa 18 million post-transaction on Antler. And then importantly, last week we announced an update to our debt facility. This was a pretty critical step for all royalty companies as they grow. We had 40 million outstanding with Macquarie Bank as a term facility. So what that means is we drew down the full 40 million, despite the fact that we're sitting on cash, we're paying interest on that full 40 million. And we don't have the flexibility to sort of pay it down and redraw it. And we're paying a coupon of 5.75% over SOFR. Whereas the new facility that we announced last week and that we're hoping to conclude documentation on in the first quarter of next year sees the coupon step down from 5.75 over SOFR to a grid of between 2.5% to 4.5% over SOFR. It depends on our net leverage ratio, but we think we'll be operating in the kind of 3 to 3.5% range, generally speaking. So that sees an immediate savings, a pretty significant savings. And then on top of that, the new facility will be a revolving facility. So instead of having a full 40 million drawn and then sitting on 18 million in cash, we can effectively pay down the facility so that you're not paying interest on the undrawn portion. You only pay a small sort of standby fee on the undrawn portion. So that also leads to pretty significant savings. The final thing to flag is that facility also had a $20 million accordion feature, which means that you can increase the size of the facility for new transactions that still stay obviously within your covenants and leverage ratios and so on. But it provides another sort of lever for us to make acquisitions, like I flagged with the Paradox acquisition. That was a way for us to deploy a small amount of capital, but secure a meaningful royalty in the portfolio. In other words, a means for us to stretch our balance sheet as much as possible to grow the portfolio without undue equity share capital dilution. We believe that the debt facility, in addition to being lower cost, offers a bit of optionality in that regard as well. So we're really pleased to get that over the line. And I think with that, Donald, I'm happy to pivot to questions.
Okay, Adam, thank you very much. That was excellent. And you have had an exceptionally busy 2023 in terms of acquisitions and so on. So I wonder if I could ask you, to what extent has the difficult equity markets actually been a bit of an open door for you in terms of actually getting those acquisitions over the line and potentially into 2024 as well?
No, that's right. It's as you said, been incredibly busy for us. And apologies, my screen dropped off here. But if I can pull up the presentation one more time, I'll flip to our share price chart. It's obviously nice to flag a share price that's sort of moving up and to the right. When we listed it, we were at 20p, as you flagged earlier. As of today, we're at 36p. So we've seen good growth in the share price over the last few years. But more importantly on this chart is the sort of sheer velocity of transactions. So I think people generally like the royalty model and they like what we're doing. Most of our peers are focused on precious metals. As I said, we've got lithium, copper, iron ore, mineral sands, looking to sort of continue to expand that diversification. But sort of the natural question that we get is, are there deals out there to be done? The strategy seems very intuitive. Why are others not doing this? And to be fair, there are a couple, but there's not very many. And so a market like we're in today, despite share prices being hit hard, including ours, this is sort of down for the year. But what we're finding is that mining companies themselves don't want to go out there and raise equity in this kind of environment. Either the capital is not available, institutional investors have fund redemptions, they're not deploying capital. If anything, they're pulling back capital. So the time is really right for a royalty company to layer in royalties on good projects. And then inevitably, when the cycle turns, we'll be sitting pretty, because it's environments like this where you can secure good deals, get good quality royalties into the portfolio. In frothier markets, those opportunities just aren't as readily available. So we're pretty pleased with where we're standing at the moment, well capitalized and well positioned to take advantage of of where we are in the sector. And yeah, as you said, of those 5 transactions, 3 of those are just in the last few months. So it's been an incredibly busy time for us.
Well, and let's be mean and ask you about 2024 then. Are you expecting to be as busy next year as you have been in the last 6 months of this year? Well, I suppose 2 acquisitions in the first half, 3 in the second half. But will you be that busy again in 2024? Or, hey, you tell us.
Yeah, it's always deal dependent. I'd say the pipeline at the moment is as robust as it's ever been. I think the couple reasons for that. One is, as we've gotten larger and better known and done more transactions, we're on people's radar in a way that we just weren't sort of a couple years ago. Even just announcing the debt facility last week, that's being provided by a couple of big Canadian commercial banks, BMO and CIBC. It's things like that get you on people's radar, and flagging access and availability of capital. So, if you're a mining company and your share price is down 30, 40% for the year, you're not in a rush to go to the equity markets. That said, you can't sit on your hands and not advance your project. So I think, we're seeing quite a few people that sort of script is flipped, and they're knocking on our doors more than we're previously where we've been knocking on theirs. So always subject to sort of deal flow and getting things over the line. But yeah, we anticipate 2024 to be a busy year as well.
Okay. Ian McGurty, thank you for your question, Ian. He asks, how is Thacker Pass profitability looking at current much lower lithium prices? So I suppose there's a theme there, isn't there? It's useful to ask you about the lower lithium price. You told us that what you said, you have, of your 21 assets, 40% is in lithium. So it's a very appropriate question for you. How have you been affected by the lower lithium price? And talk us through Thacker Pass and how that looks, even at a lower lithium price.
Yeah, no, that's a good question. So I flipped a slide that incorporates a quick synopsis of Thacker Pass. For those not familiar with Trident, this is one of our key assets. Depending on your view on lithium price, probably 25-ish to 30% of our net asset value is directly linked to Thacker Pass. That said, this year has been an exceptional year in that some big milestones have happened at Thacker. The permit was upheld on 2 occasions, and it's now sort of permitting is effectively done. It's in construction. The operator flagged that they're putting $145 million in the second half of this year, and that number is going to accelerate next year as they accelerate construction. And then the other aspect is that General Motors, they're coming in as the largest shareholder of the operator, putting in $650 million towards construction, and they'll be taking the offtake of the stage 1 lithium production and have the right of first refusal over the stage 2 expansion. So to answer the question directly, you'll see a snippet there. At current lithium prices, or sort of thereabouts, I think it's dipped a little bit since then in the last week or so. The royalty, once fully up and running, would pay about $21 million a year to Trident. Important to flag that that's a 40-year mine life, over $500 million. If prices sort of stay static, would pay us as a royalty holder over $500 million. And again, as a royalty holder, we're not operating the mine. We don't have costs associated with that. We may audit them from time to time, visit site occasionally, that sort of thing, but there's really no cost. That revenue starts flowing in, commencing, they're targeting the second half of 2026. And then from there, that revenue rolls in. And then I think the real key thing to flag is that lithium is not an exchange-traded commodity. I think as we see the rise of EVs and general battery storage for renewables, there are going to be years where lithium sort of skyrockets in demand. We saw that last year. Prices reached up to $80,000 a ton. The royalty at those prices would be paying us circa $60 million a year. And then you've got prices where it's lower, and the numbers are going to be more like 20. But with a royalty like this and a tier 1 asset that is low enough cost and has good tier one operator and good tier one off-takers, that asset is insulated from sort of those swings. And that's a key part of our diligence for all assets is, are they defensive enough to survive the cycles that we inevitably see in mining? I think Thacker Pass is a globally significant tier one asset, so it can weather those cycles. And then there are those years where we're going to make hay.
Okay, I've asked you this question before, but it is really interesting. What other elements might you be looking for to keep the portfolio diversified? And would you buy the deal opportunistically? Would you prefer to buy the deal because it was a great deal, or would you really be quite rigid and stick to that? No, I must diversify the portfolio, otherwise it's not going to be balanced as we hope it would be.
Yeah, it's a question we get pretty often. I think for us, we're still at the stage where the best deal wins. We've certainly taken into account, we'd like to broaden the commodity diversification. But frankly speaking, would we take a lower IRR deal in a new commodity versus a higher IRR deal in a commodity that we have current exposure to? It's all deal dependent, but I think at this stage in our growth, we want to get the highest returns possible. And what we've seen is that the portfolio naturally starts to get more diversified. You can see that just over the last few months. We did a copper deal in November. Let's just flag it. It's copper, zinc. It's a polymetallic deposit, so it's got some meaningful zinc exposure as well. In September, we did a lithium deal. In August, we did a gold deal. We weren't trying to cherry pick commodities there. We were just doing the best deals that were available to us. So I think that will continue to be our guiding principle. That said, if we see something that's a commodity that we really like and want to get into the portfolio, it naturally sort of pops up onto the radar in a slightly different way. So I think it's deal dependent, but by and large, it's still focusing on quality of deals above all else.
That polymetallic deal was a great example of nature introducing a degree of diversity all by itself. You got copper, zinc, and some other elements all in the same deal, didn't you?
No, exactly. Yeah, we're pretty pleased with that. It's about 50% copper revenue, 38% zinc, and then the balance is lead, silver, and gold. So yeah, through that one royalty, you're getting exposure to 5 different commodities.
Okay. Let's talk about the $40 million revolving credit facility with BMO and CIBC. So who are those lenders, and why is it so fundamentally important to you? This is something you've been working to from the moment you started, getting your cost of capital down so that you can then do cheaper and more effective deal making.
No, exactly, and you really answered it there in the latter part, because that's the gist of it. If we've got a cost of capital. There's our cost of equity, what our shareholders' return expectations are, and then there's our cost of debt. And that blended cost is our weighted average cost of capital. And really, where we can arbitrage the space is to go out there and provide capital to mining companies, either buy their pre-existing royalties that they hold on other properties, or provide them financing directly to help advance the project at a cost of capital that's obviously higher than our cost of capital, but lower than their cost of capital if they're evaluating raising equity or whatever. So that's really the gap. So the key thing for us is that with that new debt facility, we're lowering our cost of debt. So in a time where interest rates are high, share prices are down, so cost of equity, cost of debt is higher for the miners themselves. In fact, our cost of capital has been reducing now. We lowered it 2% earlier this year under the Macquarie facility, and we just lowered it again over 2% now with this new facility. So we're reducing our cost of capital, which means that we can be more competitive when we're offering royalty financing to the mining companies. We've now got lower cost of capital, so we can pass through some of that savings in part and offer them more competitive sources of financing effectively.
Okay. And BMO and CIBC, now you said in your RNS that there were lenders to the mining industry. So tell us a little bit more about them. But you didn't quite use the partnership word, but I was amazed at the language that you used around that. It was as if you were doing it together, and it was an interesting language to use in terms of a banking facility. They were almost your partners in business. Tell us about that relationship.
Yeah, those are 2 big banks. They lend to other royalty companies and lend to the mining sector. Resources is obviously a big portion of the TSX, the Toronto Exchange. So being Canadian banks, they know the space. I suppose with regards to kind of that element of partnership, I think that's true. You document these things ad nauseum. You go into real detail, obviously, when you're documenting a $40 million debt facility. That said, it does sort of boil back down to trust. as most of these things do, that we're going to manage the business appropriately. We're going to keep them informed. So I think we do view it in that sense. We'll do things per the documentation, but I think we want to view this as a partnership. They've got investments in companies, can make introductions. We can facilitate growing the facility as we find new leverageable deals. So it behooves us to treat it that way. So I think it really is a step change, and it's hard to articulate for people that don't know these banks, that the fact that they're very active in the royalty space and mining space more broadly, I think it is there's the cost savings element to it, the flexibility of a revolver, but then that partnership element is hard to articulate, but it is very meaningful as it impacts our day-to-day business.
That was a great answer. There you go. I think you articulated it very nicely. Thank you indeed. So let's turn to Oz Williams. Thank you very much indeed, Oz, for your question. It's another Thacker Pass question. Is Thacker Pass reaching production the dividend decider? So will that be the moment that you decide to pay a dividend? Asks Oz.
Yeah, flip the slide I'm showing now is one of the research analysts that covers us, their revenue profile of Trident. A couple of things to flag here to sort of indirectly answer Oz's question, but the dark blue bar that you see sort of growing there, that's currently cash flowing assets. We've got a number of assets that are cash flowing, 13 of which, and some of those are either in ramp up at the moment. They've just recently commenced production and are accelerating and ramping up. Others have sort of expansions that are underway. So we'd like to flag that, the revenue that's currently from currently operating assets, we should see over the next few years sort of a 50-60% uplift in revenue from those assets that are currently operating today. So in other words, it's sort of very safe form of growth. And then the light blue are on assets that are like Thacker Pass, either in construction today or very, very near term. So again, that's a differentiator, because I think a lot of investors probably see revenue profiles that are sort of moving up and to the right, but ours is very tangible in that a lot of growth is coming from currently cash flowing assets. And then a lot of the growth on top of that is from assets that are in construction and are going to turn on and start generating revenue. So to Oz's question, I think you can see in 2026, and then we don't highlight 27, but other assets are intended to turn on. And in fact, what you see in 26, Thacker Pass only turns on its stage one in the second half of 2026. There's not actually that much revenue from Thacker in that part of the bar. It continues to grow as they ramp up, and then as they move into phase two production as well. So that at the moment is sort of the catalyst where you see the revenue really sort of skyrocket, and it's only a matter of time. I suppose the key thing to flag is that this is the revenue profile we built in the last sort of 3+ years that we've been in existence here. The intent is to not stop now. We did 5 deals this year. We want to continue to increase those bars on this chart, bring forward revenue and bring forward the date at which we can commence a dividend. We all recognize that that's going to be a good date for the share price when we can commence a dividend. But we want to do it at the right time and ensure that the cash flow that underpins that dividend is secure, and that there won't be any changes to the dividend policy once we commit it. So it's a bit of a balancing act, but yeah, I think it's probably safe to assume that once those assets turn on and we've got a bit more certainty that as we stand today without doing any further transactions, that's probably the right time.
So let me try and pin you down. You don't have to be pinned down, but let me try anyway. Late 2026, early 2027 potentially?
I think what we'd want to do is put out a policy that then makes clear when people can see when that gets triggered. Because if you leave it opaque, then people just don't know what to expect. And we don't want to necessarily surprise people either, because then you lose a bit of the pop that comes with it. I think our intention is to really articulate a clear policy. And we've been sort of incrementally doing so, and we'll continue to do so. And then at a certain point in time, it's going to be clear to the market when we're going to trip over the sort of triggers we need to commence that dividend.
Okay, let me ask you a second and final question, which fits very neatly on, actually. You're already earning revenues from some gold assets, so do you expect other assets to become revenue producing in 2024? Talk us through what might happen in 2024 and beyond in terms of assets coming online.
Yeah, sure. This slide is the right one to show. So there are assets that turn on in 2024. In addition to the growth within the existing portfolio of cash flowing assets, Greenstone is a meaningful gold mine in Canada, been under construction for a while now, and they're flagging first gold in the first half of next year, and then intend to hit commercial production in the second half of the year. So that would be part of the light blue bar, that assets under construction with cash flow imminent, and a high degree of certainty to that eventuating. So Greenstone will turn on next year. One of the recent transactions we did this year in August on the Dandoko property, that one the operator had flagged the intention to commence production from trucking some oxide material from Dandoko to their currently producing mine. That's got less clarity in that they don't have to build the mine itself. They've got a currently producing mine with spare capacity in their mill. So because of that, and because this is a smaller property within a much larger company, there's less clarity on sort of how they're advancing towards moving into construction, but we still expect to see it turn on in 2024. And then we also flag on there the silver, precious silver royalty that we acquired this year in May. The operator had flagged, ideally they were targeting production from stockpiles before the end of the year. I think that's probably slipped to early next year. But then the commencement of production, the more meaningful production from fresh ore in the second half of next year, we expect that that's on track. So that would add a third cash flowing royalty next year. And then Sugar Zone was an asset that paused production this year. The operator is putting 100,000 meters of drilling into it, I think spending 35 to 40 million in capital, and sort of refreshing the mine plan. And it's like that should turn on sort of mid or the second half of 2024. So I think our expectation is that in addition to the assets that are currently producing, we should see around 4 assets that turn on next year alone. And as I flagged, 2 of those assets were acquisitions that we made this year. So the intent is to continue to make acquisitions such that the bar that you currently see for 2025 and 2026 also sort of incrementally move up higher.
Adam Davidson, we're out of time, sadly. That's your half an hour up and gone. That was absolutely fantastic. Thank you so much.
Great, thank you.
No, that was a terrific presentation and a great Q&A. And thank you very much indeed for spending so much time on the Q&A. I think the investors really love that.